Hello everyone, today we talk about technical analysis, triple tops and bottoms. Price partners are seen in identifiable sequences of price bars shown in technical analysis charts. These patterns can be used by to examine past price moments and predict future ones for a particular trading instrument. Readers should already be familiar with trend lines, continual price partners and reversal price partners. In this article we will explore how to interpret the patterns once they have been identified and examine rare but powerful triple top and triple bottom patterns. Key takeaways. The first is a triple top is formed by three peaks moving into the same area with pullbacks in between, while a triple bottom consists of three troughs with rallies in the middle. While not often observed in everyday market trading, triple tops and bottoms provide compelling signal to technical traders for trend reversals. In addition to chart shapes portraying the letters M or W, trading volume trends should also be employed to confirm the strength of the signal. Duration. The duration of the price partner is an important consideration when interpreting a pattern and forecasting future price movement. Price partners can appear on any charting period, from a fast 134 tick chart to 60-minute daily, weekly or annual charts. The significance of a pattern, however, is often directly related to its size and depth. Patterns that emerge over a longer period of time generally are most reliable, with larger moves resulting once price breaks out of the pattern. Therefore, a pattern that develops on a daily chart is expected to result in a larger move than the same pattern observed on an intraday chart, such as a 1-minute chart. Likewise, a pattern that forms on a monthly chart is likely to lead to a more substantial price move than the same pattern on a daily chart. Price patterns appear when investors or traders become used to buying and selling at certain levels, and therefore price oscillates between these levels, creating patterns such as flags, pennants, and the like. When price finally does break out of the price pattern, it can represent a significant change in sentiment. The longer the duration, the harder buyers will have to push to break above an area of resistance, and the harder sellers will have to push to break below an area of support, resulting in a more formidable move once price does break in either direction. Figure 1 shows a permanent price patterns that form on the weekly chart on allocate ins. One price continued in its established directions, the upward move was substantial. Volatility. Similarly, the degree to which price fluctuates within a price pattern can be useful in analyzing the validity of a price partner, as well as in predicting the magnitude of the eventual price breakout. Volatility is a measurement of the variations of price over time. Rather, price fluctuations indicate intracrate volatility, a condition that can be interpret as a more activity battle between the peers who are trying to push price down and the bulls who are trying to push price up. Patterns showing larger degrees of volatility are likely to result in more significant price moves once a price breaks out of the pattern. Larger price movements within the patterns may signify that the opposing forces, the balance of the peers, are injured in a serious battle rather than a mild scuffle. The greater the volatility within the price pattern, the more anticipation boosts, leading a more significant, possibly explosive price move as price breaches the level of support or resistance. Volume. Volume is another conditioner when interpreting price patterns. Volume signifies the number of units of a practical trading instrument that have changed hands during a specified time period. Typically, a trading instrument's volume is displayed as a histogram or a series of vertical lines appearing beneath the price chart. Volume is most useful when measured relative to its recent past. Change in the amount of buying and selling that is occurring can be compared with recent activity and analyzed. Any volume activity that diverges from the norm can suggest an upcoming change in price. If price breaks above or below an area of resistance or support, respectively, and is accommodated by a sudden increase in investor and trade interest, represented in terms of volume, the resulting move is more likely to be significant. The increase in volume can confirm the validity of the price breakout. A breakout with no noticeable increase in volume, on the other hand, has a far greater chance of failing since there is no enthusiasm to back the move, particularly if the move is to the upside. Walnuts for interpreting patterns. Three general steps help technical analysts interpret price patterns. Identify is the first step in successfully interpreting price patterns is to identify patterns in real time. The patterns are often easy to find on historical data, but can become more challenging to pick up while they are forming. Traders and investors can practice identifying patterns on historical data, paying close attention to the method that is used for drawing the lines. Then the trend lines can be controlled using highs and lows, closing price or another data point in each price bar. Evaluate once a pattern is identified, it can be evaluated. Traders and investors can consider the duration of the pattern, accompanying volume, and the volatility of the price swings within the price pattern. Evaluating this can give a better picture regarding the validity of the price pattern. Forecast. Once the pattern has been identified and evaluated, traders and investors can use the information to form a prediction or to forecast future price movements. Naturally, price patterns don't always cooperate, and identifying one does not guarantee that any practical price action will occur. Market participants, however, can be on the lookout for activities that is likely to occur and bring them to respond quickly to changing market conditions. That's all. Thank you for your attention. Goodbye.